I'm Jake Garay from the Garay-Mashaw team with Berkshire Hathaway, and you're listening to my podcast, Selling the Suburbs. I'm sitting down with real estate agents, investors, experts, and various professionals throughout the industry. On Selling the Suburbs, we're discussing the truth about real estate, entrepreneurship, and the ever-changing housing market.
I'm going to introduce our speakers. Basically, the format is Q&A. I'm going to start with a couple of questions for them, and then participation. Each of you have to ask a question, not each of you, but any questions that you have. Basically, they're here to answer any questions for you. They're all experts in their field, and they're here to kind of, answer any questions that you may have. So please utilize them, ask them any questions, and then obviously afterwards as well, we'll have some additional time for networking. So really quickly, just to introduce them, we have Deforest Howland. Deforest is from the William A. Smith & Sons Insurance Agency. He's an expert in insurance. We have Ken Stanger. Ken is an attorney out of Wappingers and Poughkeepsie. Definitely someone that's, I know a lot of people here, if you have any types of attorney questions, definitely someone that you want to talk to. And then Trish McLoughlin, who is an appraiser. So if anybody is buying real estate, refinancing real estate, any of that, those are your real estate appraisal related questions. So let's go ahead and get started, and I'm going to hand this mic to someone else. Here you go, Sean. Please no clapping. Is this on? Is this working? All right, cool. Okay, so looking at my notes here. Trish, we'll start with you. Put you on the spot right away. So for someone who's purchasing, and we'll have the mic here for you, for anyone who is purchasing real estate as an investment, whether it's a conventional loan, whatever the case may be, what are some of the health and safety concerns that someone may flag? I know a lot of people here buy investment property, especially in, say, for example, the city of Poughkeepsie. A lot of these buildings are 100 plus years old. They have been neglected. As investors, they're looking for opportunities to make a return. A lot of the time, those properties are not in the best condition. What are some things that may be a concern from an appraiser's eyes that you have to flag and kind of note during an appraisal?
Well, basically, if we're talking conventional, right? So FHA has its own list of things. But conventionally, it's really, if you were to walk through a home safety-wise, handrails, even though that's an FHA issue, but again, it's a conventional issue as well. Some of the finishes, if so much of the house is deteriorating and your cost to cure is going to go above about $2,500, now the bank is going to flag it. So if an appraiser is walking through and you've got floors that are decrepit and holes in your sheetrock, we're supposed to call it as a cost to cure fix, just so that it's livable. Whereas you might say, well, all right, a couple of holes in the sheetrock, not a big deal, but it's supposed to be livable, kind of clean, finished to an extent. So we have to call those items, and as we start adding them up, if it exceeds $2,500, now you're looking at a bank flag. So we have to put a cost to cure on it. So you just basically, when you want to walk through a home that you're looking at, just make sure that there's just, the roof doesn't look like it's fallen off and it needs to be redone right away, because we're going to have to call it as the roof looks sketchy. We need it should get an inspection. Now that if an inspector comes and calls the roof and says it really needs to be repaired now, that's a $7,500 to $10,000 job. So things like that, nothing, I think most things, if they're really super superficial, we're not going to call it. If something's just old or worn down, we're not going to call it. And sometimes the heating systems, things like that, we're not, there's no way, we're not home inspectors, we don't know plumbing. I'm not a plumber or an electrician. I'm not going to know those details. But I would make sure that there's not really visible, because an appraiser, again, we're not home inspectors. So we're going to go through sort of with a superficial eye, so you can kind of, you're saved in that sense. But if superficially things are like really out of whack, we're going to have to call things. So, walls half ripped down, that kind of stuff. If it's a really rough shape, say foreclosure property, and we see that it's been turned off, the heating systems and all that, we need to know the heating system works, that kind of stuff. So I would say, yeah, basically that's pretty much the whole of it.
I think a lot of people, they think that if they have a home inspection that they'll just accept whatever's there and then the bank appraiser will come along and save them and require the seller to fix that. That's not always the case.
Not always the case.
And even in sometimes the appraiser may not flag it, but Deforest, if the insurance company comes along. So for an investor who is looking to purchase a property and maybe they're willing to accept the condition as is, how does an insurance company, what are some of those things that they're flagging or looking at? How are they, what are they evaluating when they come out or they do a drive-by of a property that they're looking to insure?
So insurance companies will look at the property, whether they're looking at pictures or whether they're looking at the actual property, depending on the value. And they'll look at issues related to liability, some of the issues that Trish was talking about. If the house is in tough shape, the insurance company will make a judgment as to whether they would want to stay on the risk. So if there's a plan in place to fix things that are not up to code, whatever, then that's a discussion you can have, and the insurance company will stay on it. But all the things that you mentioned that are issues are things that the insurance company will look at, consider, and then take into account when they're thinking of how to write a property.
Ken, for you, the next question I have. So a lot of the people in this room will partner on certain deals, or they'll bring in an investor or something like that. From an attorney's standpoint, I'm sure you've seen partnerships that work, partnerships that go south, and everything in between. What are some of the things that if someone is considering bringing in a partner in on a deal, what should they do ahead of time to prevent litigation down the road, to prevent a lawsuit?
Well, the first thing is I can't see all of you, so I thought I'd stand up. The second thing is I've been doing this for a long time. And here's how you avoid litigation in a partnership. Spend a lot of time with the person you're going to become partners with. Make sure their dreams are your dreams. Make sure their numbers are your numbers. They can't be your best friend because you're going to have to make hard decisions. They got to be someone who trusts you implicitly. They got to be someone you trust implicitly. They got to be someone your kids like. They better be somebody your wife likes. Those are the things, because I can sit here and I can say to you, look, here's clause 17B, all lawyers use this. We'll go to arbitration if the partnership goes south. But that doesn't protect you from the risk you take in trusting somebody to be your partner. So you need to understand what it is to be a partner. It means that you have a fiduciary duty to the other person in that relationship. This is a duty different than the one you owe to your spouse. I wouldn't say it's higher, it's different, but it reaches that height. Everything you do in a partnership, you must do for the benefit of your partnership, not for your own benefit. If a deal walks in the door and it looks good for Ken, but I don't go to Jake, or I don't go to Steve, or I don't go to Dan and say, but we're all partners, I got this deal, let's share in this, then I have broken that deal. And if I break that deal, no matter what is in the agreement, I'm in trouble, I get sued. You have to think also about the fact, I think anyway, that partnerships are not for life. They're not a marriage. They're business oriented. You're going to be in a deal to make some money on that deal. And maybe if you like each other the next time, you'll be partners on the next deal. It's not like you got married. You're not spending the rest of your life. Because here's what happens, is that if you make that deal early on, and I know this because I have made this deal early on, nobody controls the clock. And things change. Families change. Spouses have different needs. Your children have different needs. Some where there's a conflict you never anticipated 20 years ago, and now it's 25 years into the deal, and there's a conflict you can't get over because it just happened. You don't know how, it happened. You have to accept that. You have to accept that as a natural evolution. So my advice to you, rather than to read to you provisions of the partnership law, is to remember three things. One, things always change. Two, that's why partnerships should be short-lived and aimed at a specific project. If you love each other enough after that deal, do it again. But don't make a lifetime of it, because three, things change. And it doesn't make anybody a bad person necessarily. Not all partnerships that I've seen have dissolved because somebody put their hand in the cookie jar. I've seen that, but when you look at the reason why the hand went in the cookie jar and you look at the people who started out swearing to be the truth to each other forever, they never knew or saw it coming. Something changed. So look hard at what you're doing with the person, keep your partnership limited in its scope, and understand the relationship you're getting into. I mean, I can give you a handout, as any lawyer would. Here are the 7 things you need in your partnership agreement. None of it matters if you don't think about what I just said. Thank you.
Thank you, Ken. So Trish, a lot of investors, like if they're someone who follows, say, Bigger Pockets or something like that, they've heard of, and maybe you've heard of this too, the BRRRR method, which is buy, renovate, refinance, and repeat, right? And it's a model to scale your business. I have a lot of clients who will contact me and say, oh, I bought this property, I'm gonna buy it. You know, I bought it 60, 70 cents on the dollar. I'm gonna put some money into it and I'm gonna refinance, take all my money out. And then they go get their refinance appraisal done and the value is different than what they thought it would be, fair market value. Now, we could have a whole conversation about what's true fair market value versus, you know, what is the value that they think it is. And obviously everybody always thinks their property's worth way more. But can you speak to a little bit of the difference or maybe your process as an appraiser when you get a contract of sale with a number versus someone calls you in to say, hey, Trish, can you come do an appraisal on my property? I think it's worth X, Y, and Z.
Okay, I'll take Ken's. Okay, so nobody gives a crap what you think your property is worth. Okay, so when I come in, whether it's a flip or an original beautiful home, or you know didn't do anything to it or you did a lot to it, I'm coming in with a fresh set of eyes, and I'm gonna look. I'm gonna take my checklist, walk through, and have a conversation with the owner, the investor, and then when I go to my computer, my process is I'm looking at comps, and the comps are the comps. So I'm looking at those. I'm looking at all the photos online. Obviously that's all I can do. I can't get into every property. So the best I can do, and I love it when the agents are very specific with their details on their listings, because that's what I'm using. Look through the photos. I'm using the comps, and as best as I can, the year, the style, the size, everything that I can to get apples to apples. And if your flip is done with, pretty decent materials, I'm looking at other things. I'm seeing and I'm making a condition adjustment. That's pretty much where an appraiser is gonna differ from another, is your condition adjustment. Mine might be, that something's looking pretty, new. It's a flip. I, can get a gist of what your materials are like. Some flippers use real basic. I've got an investor who uses me all the time, and his stuff is high end. So I know that. So I'm looking for more high end homes. So if you've got an experience with a particular investor, you know what his materials are like, you kind of know what to look for. So again, what it was when it first sold and what the guy bought it for, that has no real kind of correlation to me with what I'm now looking at as its new condition, so to speak. So when I'm looking at it as it is now. I don't care what it looked like before. I'm coming in with new eyes. It is what it is. So I'll take that. I'll look at I can usually tell what's a quick, cheap flip or what's the guy really put his heart into it, flip. I'll look at comps. We look at them accordingly, their condition, their specs, and it is what it is. The comps are going to tell me what it is, and I'll make my adjustments line by line, and I'll, And then oftentimes what I'll do is I'll sometimes call a the list agent, and I'll say, this one kind of looks like it's a little off from what I'm seeing in some of the other sales. Why? And there's always a reason. There's always a reason, and that's why I usually will make the phone call. Well, this one, they were divorcing, and it was like a shit show and whatever. Or, this one, they were moving, and they were under the gun. And so there's just usually, the market is so true to itself. And there's a reason why something is kind of off the beaten path. So I'll make an adjustment accordingly. So it's a process through, but usually there's a reason for things that are either off or whatever. But again, we look at it as it is with the new materials, the flip, and it's going to be more than obviously what you bought it for. So it just depends on what your materials were like, and we usually have enough experience to know what was a cheapie and what was a good one, and we'll look at comps accordingly, and then it's going to be what it is. Then that's what it is, and we can only bring it in for what the comps are. We'll sometimes walk through a house and the guy will be like, well, I put in this and that and the other thing, and sometimes it's so over improved for the neighborhood or the particular home, a raised ranch, they're putting Taj Mahal in. I'm like, guy, you're not getting that back. You're just not. So I had one with Blake one time, and it was in the Legends, and the Legends they're all beautiful homes, but it was a period of time where this house sold for higher than everything that was in that community. So immediately I tried to pull comps before I went, and I'm like, shit, there's nothing that's meeting the value of this home. So I'm like, all right, well, it's gonna be a toughie. So I go in, and you just feel like you're defeated at the start as an appraiser because there's nothing else that is sold for it. And no lender is gonna wanna hear that you're meeting the value based on an adjustment for a particular feature. They don't want to hear that. They need another sale that's sold for higher than what your subject is. So we went through, we looked at the house, it was stunning. There's a lot of stunning homes in there. I had them as comps, but nothing was meeting my subject. But the subject had an amazing pool. This thing was like you would go to a resort, and it was a grotto, and it was nothing I'd ever seen before. And the house, thank God, had 4 other offers that were similar. So, you gotta kind of use your words. And I just said, look, here's what it is. It had 4 offers. All were in the same range of the present purchase price offer. And it clearly, that's what gave me my adjustment for the pool. So the pool was like, I don't know, it was an $80,000 adjustment. You usually won't accept that. No bank will accept that. But I was like, I used all my comps, and I was able to extract out that value. It went through. We made it. Same thing happened with COVID. You all saw the prices were out of control. Raised ranches were selling for $5 and change. And I was like, how am I getting this? So what I did, and appraisers, there's going to be different appraisers out there, and you're going to get some that are just really, and then some are creative. I'm creative. And so what I started doing was I was like, all right, we've never seen this before. So I'm going to use all pending sales. And most real estate agents in the history of real estate agents would not give out the contract price. No, it's confidential or whatever. And I'm like, look, you're going to need me down the road for something else that I appraised. We need to help each other out here. These are unprecedented times. So please give me what your contract price is so that I can use that as a pending sale, and I could say to the bank, this is a contracted price. So what we started doing through COVID was, here were the sales that were the sold ones, didn't meet value. But I now had another 4 pending sales that all were contract prices, and I all had agents to verify these were the contract prices. Here's their values, their prices that now met my value. So I made a time adjustment that said, okay, this is what was then, the percentage. I figured out the percentage of what the time change adjustment was because of COVID. And I did a time change adjustment for all of the old sales. And so now I came to it met value, and it was based on the time adjustment. And again, most banks don't want to make value on an adjustment, but I proved it. I said, this is what's happening now. So here's what the adjustment is. This is what it would be with the adjustment. And that's why my house sold for what it did. And we had 5 other offers. So you got to get creative sometimes, but that's how it's done. And every appraiser is different. And you'll get some real a-holes who don't want to really see things as they are. So I'm kind of one of the ones, and I've had agents call me and say, Trish, and I'll call them first and say, look, it's not happening. It's not too often, but I will be like, I've done everything I can do. And they mostly know me, and they're like, Trish, I know you do that. And I'm like, you got the day. I'm not making value. I can't tell you what I'm coming in at. I'm not allowed to, but I'm not there. I'm close, but I'm not there. Okay, give me the day. Give me an hour. So they will take some time, and they'll start sending me, and I'm doing a colonial, and they start sending me, mansions and whatever. And I'm like, I can't use that. I get it, but I can't use that. So you got to be real with me, and I'm doing what I can do, but it is what it is. And obviously this buyer wanted that house. It was a, Mediterranean, whatever. And it was just really unique. And I get it, but it's unique to the area, and it's too different. And I can't get it. So, but I will give the agent the opportunity, and I will fully explain why I can't use the comp they gave me, because I had like a Brady Bunch split level in Spackenkill School District, and it was a New York City buyer, and they just spent more than they should have. And again, I've got to try to find that value. I'm kind of working for the bank here, and I can only do what's there. And so I made some crafty adjustments, but when it came to the end of it, I gave the agent time. They appreciated it. I'm willing to do that. And when all was said and done, the only things that made value were things that were mansions, and they were on the water on the Hudson River, and it just wasn't happening. So we got it as high as we can get it, and then it is what it is. So that's kind of how we work. Some appraisers will be more flexible than others. If you do come across an appraiser who is a real hard ass, you can always say, look, we don't feel that this appraiser did their due diligence. We'd like another appraisal. And they will do it. They will find another appraiser, ask, get names, find another appraiser, and just say, I want a second one. I've seen that done over again, and most lenders will allow you to do that. So that's just an option out there for you to think about.
Great.
Deforest. So for you, 2-part question. Number one, is there a difference for someone, from an insurance viewpoint, insuring an individual versus some sort of entity? So an S corp, an LLC, or something along those lines. Is there any difference in insurance there? And then secondly, what are some ways that someone who owns multiple properties can protect each property individually, right? So I know we've talked about umbrella policies, things like that. What are some ways that, you own 3 or 4 investment properties, but you don't want your primary residence to be at risk if you get sued?
Right. So is there a difference between the LLC, some sort of corporate thing, versus an individual owning properties? The insurance market generally looks at properties in terms of whether they're 1 to 4 family, whether there's a commercial exposure, and then larger type properties. Whether it's an individual or a corporation, for the most part, doesn't make a difference. And they'll underwrite the risk, based upon the appraised value, the insured value. That's a whole discussion that we can go into. To your question about how does the owner indemnify themselves for liability purposes, it's generally good to have your properties in some sort of LLC or corporate structure, which Ken can talk to. Assuming that You want to look at each property essentially as a silo. If you're a particularly large, multiple 50, 100 different properties or more, you could look at some sort of a portfolio program. I don't believe that that's really what we're talking about here. That said, having an LLC structure, having one policy for each property, having your own personal stuff separate is probably the best way that you can take care of, that one can take care of one's personal liability as it relates to your investments.
Great, thank you. And Ken, for you, so a lot of investors here will transition or have talked about transitioning into developers, right? They own multifamily, they own single family, whatever the case may be. They want to start building, they want to start developing, they want to change use. What are some of, you've dealt and litigated with many of the local townships and municipalities. What are some of the hurdles that someone who is looking to develop will face before they can even start that project? Because I don't think a lot of people understand that it could take multiple years to get a project approved before you can even do something.
Well, I think the biggest problem you have is you're in New York. Because you're down in North Carolina, you're down in Florida, you wouldn't have any of this. But we have something here that I don't really understand, but I can tell you what I do with it. I do a lot of development and litigation. And mostly I wind up with development and litigation because people go into planning boards, they go into zoning boards, they go into city councils or town councils, and they've not prepared for the litigation. We are in New York. The whole system here is designed to make you wait forever to get a simple answer. There are rules that are applied to that system. If you don't know the rules, you'll get frustrated. You'll get frustrated even if you know them, but you'll be less frustrated. So in my practice, I'll tell you that I would like to give a shout out to Richard Cantor. He's the lion. He's the lion of what we do in this county, in this practice. And I was very lucky late in life, maybe when I was 50 or 60, not this late, to have him mentor me. But he understood all of the rules, and he wasn't afraid of any of them. And if you understand the rules, you own the room, because the people that are imposing the rules on you don't. 9 times out of 10, they don't. They just have the ability to impose them. And so for me, when I meet with a client, the first important thing for me is, who's the engineer? Is that an engineer who's afraid of the town's engineer? Because engineers are adverse to conflict. They seek for a consensus of opinion because they're fact-based, not argument-based. Who's your planner? Do you have a planner who knows the rules, who understands the rules? Does their planner know the personalities that you're dealing with in that particular town? And then what's my role? My role is to just sit back and watch in case something goes wrong and then step up, because I litigate. I have no problem going in a courtroom and saying to a town or a city, or in the case of the Pelton Matter case that we have here in Poughkeepsie, the historic, or I should call them the hysterical review board, that they're wrong, that they have misapplied the law. And I will tell you this, that most folks I know, that clients that I've represented over and over, understand that confrontation brings you to truth. And that trying to get along, trying to please, being afraid to say you're wrong is the wrong strategy. You can't tell them they're wrong and they're stupid, even if you think they might be. You can't insult people, and nor should you. But you should be able to say, here's what the rules say, and you're wrong. And in order to do that, you have to have a team around you who knows the rules. Just doesn't know the people, and I get along with this guy, and I get along with that guy. Because it used to be that way. It used to always be local. But it's not local anymore. Up here, we got Westchester. Up here, we got Brooklyn. I'm up in Esopus. We got people with man buns up there trying to develop campgrounds in the backyards of people who own apple orchards. So, and they're wrong. And they're wrong. But there's a way you can say that you shouldn't be afraid to say they're wrong, but you can't say it if you don't know the rules. So that would be my advice. Hire a team to help you. Don't count on what you believe is the inner value of your project, because they won't see it. Hire people who know the rules. Hire people who don't rely on personal connection. Hire people who have personal connection because they're the best people to have the rule conversation with. But don't be afraid to stand up for yourself and understand in this state, it's an uphill battle every day. Every day. But it's worth it. I can tell you, I've been doing it for 40 years. I've been doing it with my brother. A lot of you out here know my brother Dave. And we've put together a lot of neighborhoods together. We put together the legends. And it's worth it. Because every once in a while, you'll find someone on the other side of the table who will listen to the rules and hear you. And you'll get it done. Because most folks know, when you know the rules, that you're willing to go to court. And if you're willing to go to court and you know the rules, they're going to figure it out how to get it done rather than have a fight with you. That's my advice to people who are doing this.
Great. Thank you. All right, so now I want to open it up. If anybody has any questions, somebody, anyone, raise your hand. We have a mic. Okay, we got one. Norm in the back.
Trish, I have to say, only one aspect, I may disagree with you on a few things, but only one aspect I know you did wrong. There's one person who always cares, and that's my brother Jake. So, the first property I was looking at, we were dealing with an appraisal, and the appraiser fit 3 sales comps all across Poughkeepsie, where the property was in the Union Street Historic District. Even the value was about 40% less than my purchase price. We're getting down to the wire, and I basically said to him, we know it's worth more. There were, as you said, multiple offers. But at the very end, Jake found a comp that sold that day in the last week prior to my purchase. That was actually 50% more than my sale price, and the value went up. So there are people who really care about it. But my question to you is really, a number of us are investors in the market here. How do we reconcile the fact that there are certain values you get via the sales approach, which appears to be FH, seems to be for a certain number of units and below the required approach, when you know you're coming up with a much higher value via the income stream that it produced? How do you reconcile that?
I'll be honest with you, most lenders, for appraisers that are, residential appraisers, they want the sales comparison approach. So we'll actually do the cost approach on the form. And oftentimes, if the cost approach really only works. Oh, okay. Oh, the income approach? Yeah. The income approach, it's tough because that depends on the rentals, and the rentals sometimes can be all over the place, and sometimes we can't reconcile them. So, you can only the lender will only accept rentals that are from a certain time period. We're so restricted on what we can use. And sometimes the people don't understand that. There's so many requirements of an appraiser that you just don't know. So we have a lot of restrictions, and so when we stay within them, we're only looking at a certain kind of window of comps. And so typically the sales comparison approach is what is used primarily. That's what they want to see for a 1 to 4 family. So that's usually where we're pulling from. And again, as you know, sometimes you've got a 4 family, and you look back and you look at the last 12 months, and you got to stay where your location is. City areas are easy peasy. Most times, if you've got the same type of, again, you've got so many different factors. How many apartments are in the multifamily home? Sometimes I'll get one, City of Poughkeepsie, and I'll be like, okay, well, City of Poughkeepsie, this should be easy. And then I start looking, and it's a 4 family, and I'm only finding 2 families. and I'm going back 12 months, and I don't see any 4 families. So now I got to go back 2 years, and I'm like, okay, but now how did the market change? And so there's so many factors that come into it, and a good appraiser will actually start doing time adjustments if that's necessary based on what you're seeing. But again, there's just so many little parts that you've got to kind of extract out to see, and it can get very complicated. And the rentals are, again, just sometimes what I find difficult is I'll have, say, a multifamily, and there won't be the bedroom count that I need. So then I'll be like, all right, well, if somebody was looking for a 2-bedroom and I can find a 2-bedroom house, maybe I can use that. But then that's going to have more value than one that's in a multifamily and you've got other tenants in the building. So it can be a fine line, but sometimes we're really restricted with what there is to work with. And again, there might be that perfect thing out there that just happened to close or whatever, or turn over. But, it's just a kind of get out there and work with what you've got. And sometimes we're really restricted, and sometimes the agents don't understand how restricted we are. And so I do a lot of speaking at real estate agencies to try to kind of help them understand what our guidelines are. And sometimes they'll be like, all right, well, especially square footage, above grade square footage versus below grade square footage, and we got a lot that goes on with that. And what the banks will want as far as style and bedroom count, and what's above grade and below grade bedroom count, and just factors that probably are on more of a not investor level. But so it can get a little dicey, but we do our best to try to find what's out there with the kind of requirements that we have. But
Thanks, Trish. Any other questions? Raise your hand. Anyone? Right here? Where's the mic?
Fair enough. Thanks to Lee Martin for allowing me to come out today. Love the networking opportunities, and thank you everyone for your expertise. Quick legal/insurance question. What are the chances / what risk do you run, if any, in the world of higher interest rates if you sell or if you transfer your property from personal ownership to an LLC in the era of interest rates, if that makes sense?
Wait a minute, can you try that again?
So if I hold the note and I transfer the property to an LLC that I own, let's say it's a single member LLC, what are the chances that the bank will call the note with a due on sale clause?
So basically, buys a property in his own name, quick claims the deed to an LLC. Is the bank going to call him and call the mortgage due or not?
Let's go to Vegas. I mean, what am I going to tell you? That if you took it in the LLC, the bank would have probably took the opportunity to add an extra half point to it, or quarter point, whatever they would take, but they would take that opportunity because this is what they do. They're part of the business world. This is how they make their money. Nothing wrong. Those are the rules of the game. Now, you sign a mortgage and you say, I'm not going to sell this to anybody. I'm not going to convey it to anybody. And if I do, it's due on sale. So then you do. Now, I'm your lawyer. I'm not going to tell you to do that. I'm going to ask you, please don't tell me we're doing this while you sign the deed. But the reality is, I don't know. I don't know if they have. I suppose in a low market environment that became up market, they might be checking transfers, but I have no idea. I'm not part of the bank police. Maybe we'll bring them in next time.
Thank you.
So that question from an insurance standpoint, if you change the named insured, if it's still a sole member, single use LLC, it could be as easy as, depending on the company, it could be as easy as just simply changing the name on the policy. Policy may have to be rewritten as a commercial policy at that point. It's a mechanical question, shouldn't change the pricing. What you do with the lender, the relationship with the lender has really nothing to us. We'll just make sure the lender's listed correctly.
Great. Any last questions? Anyone? Oh,
So with regards to conventional mortgages, with regards to Fannie Mae, Freddie Mac, Fannie Mae did change that rule in the banking industry. So if you do close on a home in your personal name and you want to deed it over, they do want you to wait about 12 months. However, by the time they might catch wind of it, it may have already passed. But Fannie Mae does allow properties to be closed personally and then deeded over to an LLC. Obviously, you do need to wait 12 months, but maybe you can get away with it a little sooner. So that is a new rule.
that's our guest speaker, Steve Betterton.
Thank you.
All right, on that, we'll wrap it up. Everybody, please give a round of applause to our 3 guest speakers. Thank you very much for coming out tonight. Really appreciate it. They'll all be here, so ask more questions for those of you who are afraid to come up and ask them. And thank you again.